Happy Friday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. My apologies for no episode yesterday. I wrote and recorded the episode. However, as I was recording the episode, it didn't quite feel right. It wasn't quite the quality that I wanted it to be, and so I decided not to release it. Then there was no time to rewrite and re-record a new episode. Everything is okay at my end. It's just I wanted to make sure that the videos that I release are as accurate and to a certain level of quality, and it just wasn't there yesterday. Things are back to normal now, so with that said, let's jump in. And we begin with the Chinese economy. Profits at China's industrial firms unexpectedly shrank at the start of 2025, signaling more economic headwinds than expected as the country braces for a bumpy year ahead. According to official data from the National Bureau of Statistics published yesterday, Thursday, industrial profits fell 0.3% in the first 2 months of the year compared to the same period in 2024, reversing a brief rebound that we saw back in December. Bloomberg Economics had projected a 9% year-on-year increase for the January through February period, making the contraction a significant and concerning deviation from expectations. Indeed, it's much worse than expected. Industrial and materials stocks fell at least 0.6% on Thursday morning during trading, more than double the decline seen with the general CSI, China Securities Index 300 index. The weaker earnings highlight the fragility of China's recovery, particularly as trade tensions with the United States intensify. President Donald Trump's looming tariffs could further dampen foreign demand for Chinese goods, adding to the challenges for manufacturers. With external risks mounting, policymakers may need to accelerate stimulus efforts to stabilize industrial growth. Now, not everyone was surprised with this dip, however. Peking University Professor of Finance Michael Pettis, who we often quote on this channel, expressed on this point today, quote, "For me, the surprise is not that profits fell, but rather that Bloomberg Economics had forecast a 9% year-on-year increase. I speak often to former students who run businesses in China, and they were all complaining of weak demand and falling revenues. Their complaints were mirrored by former students who work in venture capital who told me the same thing. When growth in supply outstrips growth in demand to the extent that it does in China, it is hard to imagine that businesses have much pricing power." End quote. Next up, this week Chinese AI startup DeepSeek has once again shaken up the artificial intelligence industry with the quiet but powerful release of its latest model, DeepSeek v3.0324. Unlike the highly publicized launches of OpenAI and Anthropic, DeepSeek's newest offering arrived with minimal fanfare, a stark contrast to the Western AI company's marketing-heavy approach. The 685 billion parameter model, now available on Hugging Face, is setting new benchmarks in performance, particularly in coding and mathematics. AI researcher Zeothon hailed it as the, quote, best non-reasoning model, end quote, surpassing OpenAI's Sonnet 3.5. The model's licensing shift to MIT, one of the most open-source friendly licenses, has further fueled developer enthusiasm, making it the top trending AI model on Hugging Face. The impact of DeepSeek's rapid innovation is ripping across China's AI industry. This is a space we've been following very closely these last few months on China Update. Leading AI companies such as Zhipu, 01.ai, Baichun, and Moonshot have pivoted their strategies, moving away from fundamental model training to focus on enterprise applications and industry-specific AI solutions. DeepSeek's dominance has also pressured Chinese firms to scale back aggressive marketing and reassess their business models. Internationally, DeepSeek's rise is intensifying competition with OpenAI and Google, both of which rely on premium-priced AI services. The model's impressive performance-to-cost ratio, allegedly built for a fraction of OpenAI's budgets, though there is some question marks and some debate around this particular point, has spurred a wave of cost-effective AI solutions, forcing the US tech giants to reassess their pricing strategies. However, DeepSeek's success raises questions about China's AI regulations and government influence. Some analysts speculate whether the company's relatively lenient content moderation could lead to stricter oversight. Regardless, DeepSeek's meteoric rise signals a reshaping of the global AI landscape, with China's AI ambitions challenging the traditional dominance of Silicon Valley. Next up, the Trump administration's latest tariff moves has sparked significant controversy in the global shipping industry, as the US government considers imposing substantial fees on Chinese-built and Chinese-operated vessels docking at American ports. The US Trade Representative, USTR's plan includes charges of up to $1.5 million per port call for vessels built in China and $1 million for those operated by Chinese companies, while the administration argues that this will curb China's dominance in global shipbuilding and promote American manufacturing. Industry insiders caution that these fees could disrupt supply chains, inflate costs for American consumers, and negatively impact US businesses dependent on maritime trade. The president of the Chamber of Shipping of America this week questioned the feasibility of using the collected fees to rebuild the US shipping sector, emphasizing that the funds generated would be insufficient to restore an industry that has been in decline for decades. Duncan Wright, CEO of Ohio-based freight company UWL, warned that the proposed fees could devastate businesses relying on small Chinese-built ships, impacting trucking, dock workers, and other key logistics sectors. China controls approximately 70% of the global market for new container ship orders, with its state-owned enterprises receiving substantial government subsidies and support. The USTR argues that this dominance gives Beijing undue influence over global trade. However, critics argue that the US lacks the infrastructure, workforce, and capacity to quickly scale up ship production to meet domestic and international demand. Scott Paul, president of the Alliance for American Manufacturing, defended the administration's plan, citing China's aggressive state-backed policies that have marginalized foreign competition. However, major US industry groups, including the National Mining Association and the Agricultural Transportation Coalition, have voiced opposition, warning that increased costs and logistical challenges could harm American exports and domestic industries. The proposed fees could lead to significant market shifts, with companies potentially rerouting shipments through Canada, Mexico, or other international ports to avoid US levies. Shipping experts also predict that firms may reconsider ordering vessels from Chinese shipyards to circumvent additional costs. Chinese industry officials, of course, have pushed back against the proposal too, calling it a violation of World Trade Organization rules. With public hearings on the proposal underway, stakeholders from across the shipping and trade industries are weighing in on its potential consequences. As the shipping industry braces for potential disruptions, Trump's push to, quote, make American shipping great again, end quote, could reshape maritime trade and intensify geopolitical tensions in an already strained US-China relationship. Hey everybody, my new channel market update is nearing the end of its second week. It has been wonderful to see many regular China Update viewers over there. The feedback has been amazing, and the channel is set to hit 10,000 subscribers by next week, which would be amazing to achieve in the first month. For those of you who haven't seen Market Update, it's like China Update in style, but we follow major economic and financial developments in the three most dynamic and important regions of the world: North America, Europe, and Asia. A new episode went up just an hour ago, so if you enjoy China Update and you haven't seen Market Update yet, I would recommend giving it a look and let me know in the comments what you think. If you're enjoying today's episode of China Update, as always, it's a huge help if you can like, subscribe, and both of these channels, China Update and Market Update, are both primarily subscriber supported, so if you want to help keep the channels financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much. And finally for today, the unfolding bribery scandal involving Huawei and members of the European Parliament, which we began following when it first came to light last week, has intensified, with new details emerging about financial transactions allegedly approved by the company's senior executives. Reports from Follow the Money indicate that, according to an arrest warrant, Huawei's former vice president for the European region, Abraham Liu, endorsed money transfers meant to conceal bribery payments. The scandal centers on accusations that Huawei lobbyists funneled tens of thousands of euros to members of the European Parliament in exchange for political support. Belgian authorities investigating the case recently conducted raids on the homes and offices of several parliamentarian assistants and lobbyists suspected of facilitating these payments. A key figure in the probe, former parliamentarian assistant turned lobbyist Valerio Ottati, is accused of orchestrating bribes via fraudulent invoices to the Brussels-based event firm, channeling the funds into Portuguese bank accounts to later compensate European members of parliament. The alleged bribery was tied to a letter signed by several parliamentarians in January of 2021, which argued against the exclusion of Huawei and other Chinese vendors from the EU's 5G network infrastructure. The letter warned that bans on Chinese technology were based on unfounded security concerns and amounted to, quote, technological racism, end quote. Investigators suggest that bribes included cash payments, Huawei smartphones, and tickets to football matches. The whistleblower complaint that initially triggered the investigation also alleged that an Italian member of the European Parliament received €15,000 for signing the letter, with additional payments of €1,500 per co-signatory. The parliamentarian denied any wrongdoing, claiming he had little to no contact with Huawei's representatives. The European Parliament has since revoked access for all Huawei representatives and pledged full cooperation with judicial authorities. Meanwhile, Huawei has maintained its stance of zero tolerance for corruption, but so far has declined to provide further comments on the investigations. The case draws further scrutiny to ethics within the European Parliament, particularly as it follows the unresolved Qatargate scandal, where members of the European Parliament were accused of accepting bribes from Qatar in exchange for political favours. Transparency International's Nick Iosa criticised the recurrence of corruption allegations, stating, quote, even if the sums appear small, at the end of the day, it's bribery, end quote. As the investigation continues, authorities anticipate further developments, potentially widening the circle of suspects and intensifying the legal challenges for Huawei and implicated EU officials. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Friday, have a restful weekend, and I will see you all tomorrow.